Hello, dear students. Welcome you all to the 23rd lecture of macroeconomics. And today we are going to discuss various measures to control inflation. In previous lectures, we have seen that what is inflation, what are the different types of inflation, what are the reasons behind inflation, and we discussed inflation affects to whom more. And then after we have seen how to calculate inflation in India. We discussed the WPI and wholesale price index and retailer price index. We have seen consumer price index. We have seen, and today we will discuss how we can control the inflation. So broadly, if we will see, there are two ways to control inflation. First one is your monetary measures, and second one is your fiscal measure. In this lecture, we will focus more on monetary measures, and next lecture we will see what are the fiscal measures to control inflation. So first of all, when we are saying monetary measures, I want to show you something here. So you see, we have three kind of bodies: one, two, three. Pardon me if drawing circles are not perfect. So we have RBI here. Okay, RBI is one body. Second, we have our commercial banks. Let's say B. These are our commercial banks, and ultimately we have consumers. Okay, so consumers could be individual or it could be industries. So what happens, the role of RBI is there, he controls all the operations of your banks. Okay, controls means they have a authority on these commercial banks. So how the system works between RBI and banks, it is most important to understand first of all. So what happens, RBI gives or RBI monitors the liquidity in banks. Okay, so if money required in banks, so who will supply? RBI. And if banks need some credit, where they will go? They will go to RBI. Or in case if banks have excess liquidity, so they can keep their liquidity in RBI. So what happens in case of monetary measures? RBI have a certain interest rate on which it gives the loan to banks, that is called your repo rate. And there is one another thing, that is reverse repo rate, the rate at which banks keep their money in RBI and they get interest on that. So that is called your reverse repo rate. So in monetary policy, I hope you understood what is repo rate. One is repo rate and another is your reverse repo rate. Okay, repo rate, the rate at which RBI gives loan to banks, interest rate, and reverse repo rate, the rate banks get on their securities when they are keeping to our Reserve Bank of India, RBI. So in case of monetary measures, suppose there is a lot of liquidity in market, means customers have enough money and banks also have enough liquidity. Because of that, inflation is increasing. So what will happen? The RBI will take measure to control liquidity in the market. So what they will do? They will increase the interest rate at which they are giving borrowing to banks, and further the same increase in the interest rate will be transferred to customers also. So in this case, the loans will be expensive, means customers will not prefer to take loans. So because of this also, this loans will become expensive, and customers as well as industries, they will focus more on saving instead of investment. Okay, another thing is that these banks need to keep certain amount of their whatever they have, what I will say, that amount of money, or we can say savings which are they have, they need to keep a certain amount of that to RBI. So what RBI will do? RBI will say, now you have to keep more amount of money in the market. That is your cash ratio, reserve ratio, certain portion of their savings banks need to keep to RBI. So what RBI will do, RBI will say we will increase that amount. So banks need to give more money to RBI as a storage. Okay, so in that way also RBI can control the liquidity in the market. And finally, the open market operations are there. So under open market operations, what happens? Government will start selling its bonds and securities, and they will make compulsory for banks and few industries to buy them. So in that case, whatever excess money is there, banks and some big industries, they will spend that money to buy those securities. So whatever excess liquidity is there, again it will go to RBI. So in this way, banks control the supply of liquidity in the market. Here we are not saying, we are just talking about absorbing the money from the market. We are not talking about pushing the money in the market. That we will discuss under monetary policy when we will discuss monetary policy of an economy. That time we will discuss. Here we are just talking one way. If excess liquidity is there in the market, how RBI or government can absorb that money. So I hope it is understood. Three parties are there: RBI, commercial banks, and customers. RBI has authority and they can control the operations of commercial banks. Commercial banks, that rate at which RBI is giving loan to banks or commercial banks, that is called your repo rate. And based on repo rates only, that interest rate for customers are decided. Now, if excess money is there and RBI want to control the money in the market, then what will they will do? They will increase the repo rate. If repo rates will increase, banks getting the loan will be expensive, and the same interest rate will be forwarded to customers also, and for them also the loans will become expensive. And because of that, people will start saving the money and they will not take loan from the banks. So that is one way. Another, that cash reserve ratio which commercial banks need to maintain in the RBI, RBI will increase that cash reserve ratio. So by that measure also they can control the money supply. And finally, open market operations are there, in which government will start selling. They will make compulsory for banks and big industries to buy bonds and securities of government. So that way also they can control the inflation. So this is all I have explained in one slide only. Now slowly we will move to next slide, and when next we will see how is all we can write in theoretically. So this is all we are going to discuss today. So next slides, let's see. First measure was monetary policy, is most of commonly, just give me 1 second, I will erase all these things, then we will move, otherwise again it will come. So monetary policy, when we are saying, it is related to, just give me 1 second, let me clean it. Yes, so it is like most commonly measures which are used by government or central banks, which is RBI in case of India, to control the inflation. So central banks will increase the rate of interest on borrowing of commercial banks. As a result of that, the commercial bank increase their rate of interest on credit to public also. And in such a situation, individuals prefer to save money instead of investing in new ventures. And this will reduce the money supply in the market, which is then control inflation. That is one way. Another method, which I told you, that is also very simple. In that, what they will do, monetary rise in bank rate is one way through which the government or central authority can control the inflation. So if making borrowing will be costlier, then there will be rise in bank rate by the central bank, which we were saying repo rate, and advances by commercial banks. This make the borrowing of money expensive for the general public also, because if banks themselves, they are getting money in higher interest rates, so obviously they want to generate some profit. Commercial banks also want to generate some profits. For generating the profit, they will pass that interest rate to customers also. So creating adverse situation for business, if they will increase the bank rates, automatically the psychological impact will be there to business persons, that they will think that the situation is adverse right now and they should not borrow anything from the banks. This thing we discussed when we was discussing the theories of business cycle also. So psychological theory was also there, and we discussed there that if the situations are adverse, that people will not invest in business, and because of that recessions comes. But for smaller amount or for a limited way, we can create the scarcity, we can create an environment where people will not spend a lot. And finally, increasing the propensity to save means, in this situation, whatever the people are earning, more part of that they will give for saving instead of expenditure or consumption. One way we discuss through interest rates. Second one is direct control on credit creation. So central bank directly reduce the credit control capacity of commercial banks by these two methods. One, performing open market operations, which I already discussed. In this, government securities, the central bank will issue government securities to commercial bank and certain private businesses also. In this way, whatever the excess cash is there with commercial banks, they will spend it on purchasing the government securities. Another way is changing reserve ratio. So what they will do, as I told you, certain portion of cash banks, commercial banks need to keep in RBI as a reserve. So bank will increase, RBI will increase that amount, and it will reduce the credit capacity of commercial bank also. So example, how we can understand, when a central bank need to reduce the credit creation capacity of commercial bank, it will increase the cash reserve ratio. So in that case, banks need to keep more money to RBI, okay, in RBI. So if more money they need to give to RBI, automatically their cash reserve will come down, okay. As a result, commercial banks need to keep larger amount of cash as reserve for their total deposit with the central bank. This would further reduce lending capacity of commercial banks. Consequently, the investment by individual in an economy would also reduce. So these are the three ways under monetary measures through which we control the inflation. First one, through interest rates. Increase the interest rate, repo rate you increase, that same repo rate will be forwarded to customers, and they will be more focused on saving instead of investment. Second way, government will issue securities for commercial bank and certain private banks, and they will buy those things, and excess money again will go to government. And third one is changing reserve ratio, under which if RBI is increasing the cash reserve ratio, so bank need to keep excess amount of their reserve to RBI, and that way also they can control the excess amount of liquidity in the market. So I hope these 3 points are clear to you. Thank you so much for watching the video. If you have any confusion, you can call me or you can ping me on WhatsApp. I will solve your query there. Thank you.